Assalamu alaikum. Today's lecture is about international arbitrage. This is from finance specialization, and in this we will learn what is arbitrage, and we will also learn the types of the arbitrage. So let's get started. This is the first slide. What is arbitrage basically? So there is a simple definition of arbitrage. It is capitalizing on discrepancy in quoted prices. Now, capitalizing is about earning benefit or earning profit on a discrepancy. Discrepancy is the tiniest differences that happen or they occur in the prices that are quoted by banks. We are talking about the currency or the financial markets of the banks who have a variation in the prices of their certain currency. For example, if it's dollar, the price of the dollar is not same for every bank. Okay, they are keeping the difference in the prices. There can be the reasons why prices differ that we will discuss, but for now we will focus on arbitrage. It's about earning by the smallest differences. See, the differences are smallest, tiniest. They are not large, they are not huge, and they occur while buying and selling of assets in financial markets. Here that asset is currency. Okay, so three types of financial assets can be used to generate arbitrage. Those are stocks, commodities, and currency. So in our case, in our chapter, in our lecture, we are going to study currency, that how can we arbitrage from currency. Other thing that's very interesting about arbitrage is the very interesting feature about arbitrage is that the profit earned by investor is risk free. This is a very interesting feature of it, because most of the investments that we make or most of the funds that we put in our projects or somewhere, there is a lot of risk involved, be it stocks or be it debentures. These are the financial instruments. But if we talk about certain projects that we are going to invest our funds for a longer period of time, then still there is a percentage of fear in us to not to lose. We just don't want to lose our investments. So, but anyways, here in arbitrage, that risk is not existing. The reason is because whatever you buy or sell, it's instant. It's not taking any longer period of time. You buy from one place, you sell to the other place, and in between, the difference becomes your profit. It's that simple. So that's why we call it's a risk free. Often the funds invested are not tied up for any length of time and no risk is involved, as I told you. So this feature makes it more favorable to many of investors. There are the types: locational arbitrage, triangular arbitrage, and covered interest arbitrage, and in this lecture we will discuss locational arbitrage. So let's see that what is locational arbitrage. Simply capitalizing on rates quoted by banks. It's that simple. You don't have to get into any hassle. It's just the rates that have been quoted by banks, and the difference between the rates is your profit. Note that for same currency, different banks have different quotes. As I told you that a dollar at bank A, the price of the dollar at bank A will not be similar to the price of the dollar at bank B. It will definitely differ. So the reserve that they maintain, of the foreign currency reserves maintained in the banks, have different charges for it. So they buy at some rate and they sell at some other rate, and that rate will definitely gonna be different to the other banks. So there is a benefit for any kind of person who wants to earn benefit from that. So the difference is, the key lies in the difference. The other thing over here is that if only and only if the difference is there, then arbitrage is possible. So first thing first, being a smart person, you would like to see if the differences exist between two banks, and if it is, then the locational arbitrage is possible, then you can do it. The good thing is that it's instant, as because it's not time consuming. You're not tying up your funds at all. You can buy and sell right away. So we say that you are away from risk, and that's a good thing. That's a very good thing for most of the investors. Now we will see that how does it work. Suppose there are two banks involved, Bank A, Bank B, both are selling same currency, buying and selling same currency. So if we know that the dollar is available at both the banks, so how can we capitalize on the dollar? And the rates are also available. I haven't put rates over here, but just for the sake of understanding this simple concept. So what we will do, we will buy at low price from Bank A, because among both, the bank A is the one who is charging less for giving you a dollar, for selling you a dollar. So what I will do, I will buy from bank A and I will sell it to bank B, because this bank is getting dollars and paying us more for each dollar. So per dollar, in the first place I am paying less, and the other place I am selling at a high price. For each dollar I am gaining more. So the difference between both becomes my profit. So this is about the locational arbitrage. It's so simple. Then we are coming to an example. Suppose bank A and bank B. Bank A quotes $1. It is equals to 182.35. This is the rate of Pakistani rupee. And bank B is quotes $1 is equals to 183.10 PK. This is the rate of the same day. Consider it's the rate of the same day. So and another thing I would like to tell you, that 182.35 is the price of $1. It means that consider $1 is simply as a commodity, as a good, or any product that we simply go and pay for it in the market. We pay for certain goods in the market and we get the good and we pay the amount. So this is the amount that we are required to pay for $1, for buying $1, for each $1. After clearing that, you have to see that both of the banks, the quotes they are offering, either they are different or the same. So we see that there is a discrepancy. We see yes, there is a discrepancy. In the first place, we say that the locational arbitrage is possible. Yes, it is. Then we have to play the game now. What we have to do, how we can capitalize from this quote, we can buy low, we can sell high. So the low rate, which bank is offering the low rate? The low rate is being offered by bank A, of course, 182.35 PKR. So we will buy from bank A and we will sell it to bank B, which will give us 183.10. So it's very much clear that we paid less, we got more, and the benefit is here. Okay, so this is a locational arbitrage example. Another thing, I have just ignored the 0.35 and 0.110 from the codes, just to make it simple and to make you understand. So this is how the arbitrage is working. Now, before moving to the next slide, I would like you to tell quickly about bid and ask prices. That in the trading, be it of commodities or financial securities or financial instruments like stocks, bonds, currencies, whatsoever, it's always about the term which is called the negotiation. Negotiation is basically a finding of the best price where both the parties, the buyer and the seller, are agreed, or they are satisfied and they are happy. So this term is very important. This term brings us to the bid and ask prices, because bid and ask prices are those which are agreed upon, which are suitable for both parties. So bid price is a maximum price that a buyer is willing to pay for currency they want to buy. It's simply the maximum price the buyer will pay you in return of the in exchange of the currency that he is buying. And ask price is ask price is a minimum price the seller is willing to sell currency they own. And the difference between both of the prices is the spread. Now here is an example. Suppose in a bank A, the US dollar on PKR, the rates are 85.15, 86.25. So it means that they will pay you 85.15 Pakistani rupee when you will sell dollar to the bank. You will sell dollar to the bank, they will pay you 85.15. Or in other terms, we will say the US dollar. For US dollar, the bank becomes a buyer. When the bank is a buyer, so it will pay you for every $1, it will pay you 85.15. And in other scenario, when the bank is selling the dollar, here the bank is buyer. Here the bank is buyer and here the bank is seller. So when it will sell dollars to you, it will charge from you this much amount. So this becomes the ask rate. This becomes the ask rate, this becomes the bid rate, and it will charge you for every dollar 86.25. So you see clearly over here that the two rates are different, and it's buying it low and selling it high, the dollar. So this is how the bid and ask is working, and the difference between both becomes their spread or the benefit we say. Here is an example. Bank A has a quote of US dollar per PKR is 85.15, 86.25. This is the first one is the bid rate, and this is the bid rate, this is the ask rate. And bank B, which is buying dollars from you at 86.75 and selling you dollars by charging you 86.95 rupees, it's in PKR. So if you must trade $100,000, is locational arbitrage possible? So we have to calculate the profit as well. Yes, so step number one is that we are out of dollars, we don't have dollars, we have Pakistan rupee. So we have to look for a very ideal bank which is charging very less from us for on purchase of dollars. So we have to pay less amount of Pakistani rupee to that bank. So another thing is that this is the step number one. Another thing is that when we are buyer of dollar, because I want $100,000, and when I'm buyer, the bank is seller, and when I am seller, the bank becomes buyer. So in case right now I have to buy dollars, I'm a buyer, so I have to look in bank selling rate. So that is the ask rate. I have to look into the ask rate. Whichever is less, I will go with it. So the selling rate of bank A is 86.25. They will sell dollars at this rate, and bank B's rate is 86.95. So the least from them is of course bank A's rate. I am choosing this rate, and what I have to do is simply to multiply $100,000 that I want, multiply by the rate for every $1 I have to pay. The total amount is this 8,695,000 PKR. This is the amount that I have to pay to bank to gather the dollars of equaling 100,000. In after having done that, I would like to sell the same amount of $100,000 to the bank which is offering more payment to be made when they will buy from me. Okay, so I have to when buying, when I become the seller, now the bank becomes the buyer. In this case, I have to look into the bid section of the bid section. Then in the bid section, I have to look for the maximum rate the bank will offer me for the dollars that I will sell to them. So the maximum amount is 86.75, of course. So I will multiply the same amount of dollars, and I will get the amount 8,675,000 PKR. So now I bought at this rate and I sold at this rate, which is, and the difference between both is my profit. So the profit becomes 50,000 PKR, and this difference is without doing any kind of hassle, without doing any kind of entering into trouble. I have gathered this benefit. Thank you so much. Allah Hafiz.